we did talk about that, and we were just saying that we take the law of the two and then use that as the inventory cost on our balance sheet. But how exactly do we do this? Okay, so there are two methods that are available to account for this particular method for the valuation. And one is the direct method, and the other one is for the allowance method. Okay, so once again, the company is free to use either of the two. And you will be given the journal entries for both of them. So let's take a look at a very simple example once again. So there is a company with 3 different inventories. So there will be inventory A, B, and C, or item A, B, and C. And you are also given the quantity that they have in their store, the cost per unit that they buy, that they purchase at, or that they bought at, and the net realizable value for every single unit. So remember, net realizable value is the estimated selling price minus the cost to sell. So any selling cost that you have to pay, for example, commission that you have to pay to the customers. But in this case, you are actually given directly the NRV, which is net realizable value, so you don't have to calculate that by yourself. But sometimes you will be given, for example, the estimated selling cost, and then the selling commission fees and stuff like that, so you would have to calculate the NRV by yourself. So determine the carrying value of the inventory at the end of the period. Prepare the necessary journal entry using the allowance method or the direct method. Okay. So our main idea here is to compare the cost and the NRV, and then to take the lower of the two. The lower of the two. So first of all, we can calculate how much is the total cost for item A. And that would be 100 units times $90. That would give you $9,000. And then similar logic for item B and item C. So you would have the total cost for A, B, and C. Okay. And the next step would just be to calculate the total NRV. So that would be $100 times $80. And so on for B and C. And you would have the total NRV for A, B, and C. So basically, your first step is to calculate the cost and the NRV for every single item that you have. And then step 2 is for every single item that you have, you are going to calculate whether the cost is lower than the NRV or not. Okay, so that you are able to take the lower of the two. So for example, for item A, the lower of the two is $8,000. So the market price, which is the NRV, is lower than the cost by $1,000. So you are going to write down the inventory by $1,000. So originally you have $9,000. After writing down by $1,000, you are left with $8,000. So what you have on your balance sheet right now would be the NRV rather than the original cost. Okay. And similarly for item 2, total cost is $10,500. And your market value, which is measured by the NRV, will be $7,500. And now the lower of the two would be NRV, which is $7,500. So you are going to write down the value of the inventory from the cost, which is $10,500, down to the NRV, which is the market value. And that will be $7,500. And the write down, which is the decrease in the value of the inventory, is $3,000. So whenever you see the word write down, what that means is you are decreasing the value of something. Remember last class when we were talking about the write down of accounts receivable? We are actually decreasing the value of accounts receivable. And here we are decreasing the value of the inventory. Okay? So any questions for A and B? For both A and B, the market value, which is the NRV, is lower than the cost, so that's why you have to write down the value. Okay. But something different happens in item C. Item C, the total cost, which is the original value, is $10,000, while our market value, which is the NRV, is $12,000. Here, the lower of the two is the cost. Okay, so we are going to take the lower of the two, which is the cost. So what that means is we are not going to write that up to the market value. So as you can see, for inventory, we are only going to write down to the market value. But if the market value is higher than the cost in the original case, in the first year, then we are not going to write it out. Okay. So as you can see, the write down for item C will be $0. So in other words, we don't have to do anything for item C. So now, after you calculate the write down for item A, B, and C, you can take the total of the three, which is $4,000, and then prepare for the journal entry. So in terms of the allowance method, here, we are going to use an XA account. Okay, so by now, I think you can see that whenever we are talking about allowance, that is a contra account. So for example, last week, allowance for doubtful account, that will be a contra asset account for accounts receivable. And here, allowance to reduce inventory account, that will be a contra asset account for inventory. So that reduces the value of the inventory that we have. Okay, so we are going to debit a loss due to market decline of inventory, which is an expense or income statement account. And then we are going to credit the allowance account, which is a contra asset account. Okay. And in terms of the direct method, the only difference is we are not going to create the contra account, but rather directly reducing inventory by $4,000. And then debiting the holding loss, which is an income statement item as well. Okay. So the main difference is this one here, there's an allowance account. This one here, there isn't. And for the income statement account, the names are different, but essentially they're the same thing. Any questions about that? Yes. Exactly right. $4,000 is just 1,000 plus 3,000 plus $0. Okay. Yeah. So the question is, the $4,000 is the sum of the write-downs. Any other questions? So that would be the difference between the allowance method and the direct method. One uses the contra asset account, one does not. Okay, so let's get to the very last topic, which is estimating the ending value of the inventory. Okay, so sometimes we have to estimate the ending inventory. Why is that the case? Okay. Didn't we just talk about that we are able to perform a physical count so that we can get the ending inventory, even if we are using the periodic system? That is true in most of the cases, but now think about if there is a case in which a fire destroyed the entire warehouse, so that we don't know how much inventory we had right before the fire, assuming that we were using the periodic inventory system. But in this case, you may think that, so why do we care how much inventory we have? Okay. The answer is we want to get that number so that we are able to claim insurance, for example. So in that case, how exactly are we going to go about in terms of getting the ending value of the inventory right before the accident? Okay, so we are going to use the particular method here, which is going to be focusing on our inventory equation. Okay. And on top of that, we are going to use something called the cost to sales ratio. So what does it mean by the cost to sales ratio is the numerator will be the cost, and the denominator will be our sales revenue. So cost of goods sold divided by our sales revenue would be our cost to sales ratio. So for example, if we are selling a product for $1 and our cost of goods sold is 70 cents, then our cost to sales ratio would be 70 cents divided by $1, which is 70%. Okay, so things like that. And we are also going to use our equation, beginning inventory plus purchases. That gives you the cost of goods available for sale. Okay, so that is how much you have from the beginning plus how much you purchase from your suppliers. So if you add the two numbers up, you know how much you have that will be available for selling to the customers. And then now if you take that number and then minus the actual cost that you sold to the customers, then you would have how much you have left in your ending balance. Okay, so those are the two equations that you must know. And these two, if you combine those together, this is actually the one that we just talked about right at the beginning of the lecture. Here we are just expanding that equation by a little bit so that we have one more item here, cost of goods available for sale. Okay, so how exactly do we calculate something like that? So for example, we have a beginning inventory, which is $100,000. And then during the year, we purchased $200,000. And then we also sold goods for $250,000, and that will be at the selling price. And you have a cost to sales ratio of 60%. So what does it mean? What that means is for every $1 of sales revenue, you have 60 cents of the cost of goods sold. Okay? So based on all these numbers, you want to estimate how much ending inventory you have. Imagine you have a fire destroying the entire warehouse. Okay, so you want to get that number. Okay. So first of all, if you go back to the equation that we just talked about, we have the beginning balance, we have the purchases, but it looks like that we don't have the cost of goods sold. Okay. Because we want our ending inventory, right? So essentially we have to have beginning purchases and the cost of goods sold, but we don't have that. So how we are going to find that is through the use of the cost to sales ratio. So how are we going to use that is we take the amount of the sales that we have and then times that by the cost to sales ratio. Okay. So that's going to give us our cost of goods sold, right? Because sales times cost to sale. Okay, so these two get cancelled out, so you're only left with the cost. Okay, so that's why you're able to use the equation to find out the cost of goods sold. So that would be the sales times our cost to sales ratio, which is 0.6. And then now all you need to do is to plug in the numbers into the equation so that we have our beginning inventory plus purchases minus the cost of goods sold to get our ending. And these two numbers are given. And all you need to do is just to calculate the cost of goods sold based on what we just had in the above. So now we are able to calculate and then get the number, which is 150,000. Okay, so this is only a very rough estimate, but at least we know how much we had right before the fire so that we are able to go to the insurance company and then claim for the loss. Any questions regarding how to get the ending inventory if we are not able to perform a physical count? Okay. So the very, very last thing is to talk about the ratios for inventory. So up to now we have talked about a few ratios, usually based on profitability. And then we also talk about accounts receivable ratio last week as well. So here we are going to talk about the performance of the company based on inventory. And what exactly we are going to do is we are going to talk about a ratio called inventory turnover. So that is how fast you are able to sell your inventory. The logic is the same as last class, which is the accounts receivable turnover. Remember, accounts receivable turnover measures how fast the company is able to get the cash back from the customers. So the higher the number, the better the company is. And here the logic is the same, how fast the company is able to sell the inventory. Okay. So usually the higher the number is, the better once again, because that means you're able to sell the inventory faster. Okay. The faster you sell your inventory, the more profit that you can get. So what you're going to do is you're going to take cost of goods sold divided by the average inventory. Okay, so for example, an inventory turnover ratio of 3. So that is cost of the goods sold is 3 times higher than the average inventory. What that means is you are selling your